All right. Hey, I don't know why, but I love saying that. So I said to myself that I want to be consistent with trading Forex, and I have been, but like kind of procrastinating finishing this book. I've been reading a little here and there, but kind of procrastinating. So I'm going to continue where I left off. Probably been reading this book for about 2 weeks now, and honestly I feel like it's been too long, so I'm going to push myself to finish reading this book. Now, last thing I definitely do remember is the exiting. So I'm going to continue reading from this point. If you have read this book, you should know I'm not reading this for anybody else. I'm only reading it for myself. So, great book. This is the PDF version of it. Once again, this book is called Naked Forex, and it's just been a trading journey. So is a okay. The first exit for runners is similar to some of the gunner exits. This exit is called the ladder exit. The second exit for runners is a little bit different because this is not based on the zones. Both of these exits are classified as trailing exits, which simply mean that they are taking advantage of trending markets. Trailing exits, an exit strategy that is dynamic with no fixed exit price. The exit price consistently adjusts with the movement in the market to maximize profits. All trailing exits are a compromise. There are two parts of the trailing exit. The trailing exit must allow a cushion so the market may move against the position, and the trailing exit must have a line in the sand to capture the profit once the market moves too far against the position. Both the ladder exit and the 3-bar exit do the best during trending markets. The ladder exit uses zones to identify profit targets, whereas the 3-bar exit uses an entirely different approach. Ladder exit. The ladder exit is similar to the previous exit in that zones are used to identify profit targets. The difference, however, is that each zone is a potential profit target. When using the ladder exit, the naked trader never knows where the final exit price will be. This is because the ladder exit allows the market some breathing room. This is how the ladder exit works. Once a trade is initiated, the stop loss is moved in accordance with how far the market has moved. So, for example, if the market moves from the entry price to the closest zone, then the stop loss is moved to break even. Once the market moves further to the second closest zone to the entry price, the stop loss is moved from break even to the first zone, and so forth. The easiest way to see how the ladder exit is executed is to look at an example. Figure 11.6 is the GU 4-hour chart. A bearish big belt prints on the 1.6460 zone. A bearish big belt. A big belt is when it usually happens over the weekend and it closes down here. You guys can't see my mouse. Sheesh, that is crazy. That is crazy. So if you look right here on this graph where the number 2 is, the number 2 line, that is where price closed the previous week. Well, if you look where the arrow is, that is where price opened. That is where price opened at the beginning of the week. The difference between that number, well, the difference in between that price, including the bearish zone, well, the bearish candle, I'm sorry, not zone, but so the difference between that price and the bearish zone is what makes a big belt. They also talk about big belts in this book, so if you haven't read this book, go take a look. A bearish, well, the market trades down to the 1627 zone, so the stop loss is moved from the high of the big belt candle to break even. Then the market hits the next zone at 16135, so the stop loss is moved to the 16270 zone. The market turns around and trades back up to the 1.270 zone, where the trade is exited for a gain of 28 pips, 128 pips. This is a bearish big belt on the GU 4-hour chart. 1. The stop loss is above the high of the bearish big belt. 2. The stop loss moves to break even once the market reaches the first zone. 3. The stop loss moves to the first zone once the market reaches the second zone. This is where the trade is exited for 128 pips. Patience is needed to employ the ladder exit. Take a look at figure 11.7. This is another example of the ladder exit on the EUR USD weekly chart. Here we see a bullish kangaroo tail. The market immediately trades higher than the kangaroo tail and reaches the first zone at 0.8750 quite easily. At this stage, the stop loss is moved to break even. The market trades higher to reach the zone at the 0.91 level. Here, the stop loss is moved to the first zone down at 0.8750. Next, the market makes a move higher and reaches the next zone at 0.9330. So the stop loss is moved to the second zone at the 0.91 level, and this is where the trade is exited for a gain of 575 pips. The ladder exit on a weekly EUR USD bullish kangaroo tail. 1. The stop loss is first placed below the low of the kangaroo tail. The stop loss is moved to break even once the market reaches the 0.87500 zone. The market trades up to the next zone at 0.91, so the stop loss is moved to 0.8750. 4. The market reaches the next zone at 0.9330. So the stop loss is moved to 0.9100, and this is where the trade is exited for 575 pips. So number one, kangaroo tail. Number two, we get in for a buy stop. And number three, we exit taking our partials. Number four, we exit taking partials again. Number three is where we leave our stop loss. Once we hit number four, our stop loss is now at number three. Using the latter exit will allow the market a cushion of one zone. This may seem they just act like the Wi-Fi is just not connected or something. I need something. Alright. The 3-bar exit. 3-bar exit is a unique exit because, unlike the previous exit, it does not involve zones. The 3-bar exit gets its name because the exit is based on price action of the most recent 3 bars or candlesticks. The exit is a simple trailing exit based on the lowest low of the previous 3 candlesticks for buy trades, or the highest high of the previous 3 candlesticks for sell trades. The naked trader locks in profits by trailing the stop loss behind the lowest low for buy trades of the previous 3 candlesticks. Take the example on 1 hour GA chart. This trade is obviously a bullish trendy kangaroo on an excellent zone at 1.5868. Okay, so this is the bullish kangaroo right here where the arrow is. All right, the stop loss, figure 11.8. The stop loss for the GA 1 hour trendy kangaroo is first place below the low of the candlestick. The market prints 3 candlesticks after the trendy kangaroo. The stop loss is moved below the low of the lowest candlestick. The lowest of the 3 candlesticks in figure 11.9 is the 3rd candlestick, the candlestick immediately after the trendy kangaroo candlestick. The stop loss is moved to just below the low of the candlestick immediately following the trendy kangaroo candlestick. Figure 11.9. The 3-bar exit applied to the GA 1 hour chart. Once the market has printed 3 candlesticks, the stop loss is moved beneath the lowest low of the most recent candlestick. In figure 11.10, the 3-bar exit is applied to the GA 1 hour trending kangaroo. One more candlestick prints, and so the stop loss is moved higher. This time it is placed below the third most recent candlestick below because it has the lowest low of the stage of the trade. Okay, so 3 bars is okay. The 3-bar exit applied to the 1 hour GA trendy kangaroo trade. The market moves higher and the stop loss is placed just below the lowest low of the most 3 recent candles. In figure 11.11, the market moves higher once again after another 1 hour candlestick closes. The GA 1 hour trendy kangaroo is trending nicely, and the 3-bar exit is locking in profits as the market trades higher. One more candlestick prints, and the 3-bar exit is just adjusted once again. This time the third most recent candlestick is again the candlestick with the lowest low. So the stop loss on the GA trendy kangaroo trade is placed below the third candlestick. The 1 hour chart for the GA changes drastically as the market makes a strong move downward. See figure 11.12. At this stage, the candlestick with the lowest low is the most recent candlestick. So according to the 3-bar exit rules, the stop loss must be placed a few pips below the most recent candlestick. In figure 11.12, the most recent candlestick on the 1 hour GA chart makes a strong move down. The stop loss is placed below this candlestick because it has the lowest low of the most recent 3 candlesticks. One more candlestick prints, and the trade survives by a whisker. Oh, that's crazy. The new candlestick is slightly lower than the previous candlestick, so the stop loss is placed below the most recent candlestick. Why are they moving their candlestick? That's what I'm trying to understand. Like, why are they moving it? The GBPJPY 1 hour trendy kangaroo trade survives after the next candlestick prints on the chart. The most recent candlestick now has the lowest low, so the stop loss is placed a few pips below the candlestick. The next 1 hour candlestick on the GA 1 hour chart prints slightly higher. Then the stop loss remains at the same location because this second candlestick still has the lowest low of the most recent 3 candlesticks. The stop loss for the 1 hour GA trendy kangaroo trade remains the same because the most recent candlestick does not present a lower low. The 1 hour trendy kangaroo trade on the GA chart is closed out on the next candlestick. The most recent candlestick pushes through the stop loss, and so the trade is closed for a modest gain of 13 pips. For this to be the 1 hour, this is wild that you only got 13 pips out this trade. Well, this is the trailing stop though. I definitely understand that. All right. The next candlestick triggers the 3-bar exit stop loss. The most recent 1 hour GA trade low and trades low enough to hit the stop loss, and so the trade is over after a gain of 13 pips. Some of the trades that are managed according to the 3-bar exit will end up with similar results to this GA 1 hour trendy kangaroo trade. The 3-bar exit is ideal for a strong trending market, but if the market does not continue moving with a strong trend, the 3-bar exit will only capture minimal profits. Although this may seem discouraging for some traders, particularly gunners, for runners who take the long-term perspective, a few losing trades or minimal gains are accepted. Runners understand that the large gains will come from time to time and make the 3-bar exit a worthwhile exit strategy. Another example of the 3-bar exit is in order. This time it is the AUD/JPY daily chart, and the trade setup is a bearish big shadow. Some naked traders may argue that this setup is not a bearish big shadow, but something else. Go to that website to watch a video about this trade. The original placement for the stop loss is just above the high of the bearish big shadow candlestick. See figure 11.16. Figure 11.16, the initial stop loss placement for the daily AUD/JPY bearish big shadow is just above the high of the big shadow. Okay. The stop loss remains above the high of the big shadow until 3 more candlesticks print after the bearish big shadow. The stop loss is moved a few pips above the highest high of the 3 most recent candlesticks. Okay, so I get what they're saying. It's the 3 most recent candlesticks. The height of the 3 of the, the past 3 candles. So after 3 candles print, then you're moving your stop loss up. Understandable. As figure 11.17 illustrates, the highest high of the previous 3 candlesticks is the candlestick immediately following the big shadow, so the stop loss is placed above this candlestick. According to the 3-bar exit, once the 3rd candle prints, the stop loss may be adjusted. In this case, the first candlestick after the AUD/JPY daily bearish big shadow has the highest high of the 3 candlesticks. Thus, the stop loss is placed a few pips above this candlestick. So, 1, 2, 3 candlesticks move stop loss. All right. The next chart, see figure 11.18, shows 4-hour candlesticks after the bearish big shadow. The highest high of the most recent 3 candlesticks become the most losses placed a few pips above the high of the most recent candlestick. It is important to note that according to the rules of the 3-bar exit, the candlestick must close before the stop loss may be moved. Interesting. This most recent candlestick on the daily AUD/JPY chart becomes the candlestick with the highest high. Thus, according to the 3-bar exit, the stop loss is placed a few pips above the high of the most recent candlestick. Another candlestick prints and the candlestick with the highest high remains the same. The stop loss is not moved because the second most recent candlestick still has the highest high. Using the 3-bar exit, the stop loss placement on the AUD/JPY daily bearish big shadow trades remains the same after 1 more candlestick prints. The next day, the market takes another fall. Okay. The stop loss remains the same above the 3rd most recent candlestick. The 2 more recent candlesticks have lower highs, and according to the 3-bar exit, the stop loss placement is above the highest high of the prior 3 candlesticks. The market makes another move down, but the stop loss placement on the AUD/JPY daily bearish big shadow trades remain. The stop loss remains a few pips above the high of the 3rd candlestick. This time the stop loss for the trade is moved, once again as shown in figure 11. The next candlestick prints in the highest high becomes the third most recent candlestick. So the stop loss is placed a few pips above the high of the candlestick. When using the 3-bar exit, if the stop loss is placed above the third candlestick, then it is known that after the next candlestick prints, the stop loss will be moved. The market prints another small candlestick, and the AUD/JPY trade has a new stop loss placement above the third most recent candlestick, according to the 3-bar exit rules. Another candlestick prints, and the highest high is once again the third most recent candlestick. So the stop loss is moved a few pips above the high of this third candlestick, as is seen in figure 11.22. Again, since the stop is above the third candlestick, there will be another stop loss adjustment once the candlestick prints. After a new candlestick prints, the stop loss is placed a few pips above the third most recent candlestick. The candlestick with the highest high of the previous 3 candlesticks. One more candlestick prints, and the new highest high is the most recent candlestick, so the stop loss is placed a few pips above the candlestick. The most recent candlestick has the highest high of the 3 most recent candlesticks, so according to the 3-bar exit, the stop loss is placed above this candlestick. The market has finally triggered the 3-bar exit shown in figure 11.24, and the trade is over. The most recent candlestick takes out the stop loss. This bearish big shadow on the AUD/JPY daily chart has netted 137 pips by using the 3-bar exit. The most recent candlestick trade through the stop loss. The bearish big shadow trade on the daily AUD/JPY chart has captured 137 pips. So for what I'm understanding, I am a gunner that has potential to have trades run. So I like fast entries, get to my take profit within 45 minutes, get to an imbalance, and then I put break even. I'm not too many, I don't care too much of getting break even or even losing a trade at all, because I'm only risking 1% of my account. 122%. Let me acknowledge that. I'm trying to get the most. Okay. The 3-bar exit works best when the market accelerates into a strong trend. As long as the 3 most recent candlesticks are following the trend, the 3-bar exit will trail slightly behind the advancing candlesticks, capturing profit along the way. This exit is ideal for runners who are interested in capturing large profits. At times, the 3-bar exit may be frustrating. Some trades will end up as losers. Other trades may give back much profit, but if used consistently, this trailing exit will capture big moves. The key to this exit is to use it consistently for every trade. Runners are like all traders. They never know when the next big trend will pop up. But gunners who apply trailing exits such as the 3-bar exit are ready to capture profits from the next trend in the market. Exactly. Managing exits. A common problem for traders is retrading the most recent trade. This issue is extremely common for traders struggling with an exit strategy. Traders will take a close look at a recent trade, see where improvements could have been made, and then decide to change things next trade. The problem with this strategy is that every trade is different. The previous trade has nothing to do with the next trade. Every trade is an independent event. When traders fall into this trap of retrading the previous trade, bad things often happen. If you have found yourself adjusting your strategy in general or changing your exit strategy in particular based on what occurred in the previous trade, you are falling into this trap as well. So if you adjust your strategy or change your exit strategy based on whatever occurred in the previous trade, you are falling into this trap. So keep the same strategy. Keep the same strategy. Simple as that. Just keep the same strategy. What's the point of changing your strategy when you can keep it? You know your strategy is good. It's proven to get you a lot of money. Just because it don't go right one way or one time doesn't mean anything. Okay, good knowledge. Perhaps you take a trade and the market runs for several hundred pips in the expected direction, long after you exited the trade. This may encourage you to change your exit strategy on the next trade. The problem with this is the next trade may not run for several hundred pips. It may only go to the next zone, which means that you will reduce your profitability even further. Decide which type of trader you are going to be. Either you will be a runner or you will be a gunner. Stick to one exit philosophy. But what if you want to be both? Decide what makes sense to you. If you are a gunner, do not get upset if the market runs for 500 pips. See, if we got the mindset of a gunner and we don't even expect it to go 500 pips. But if we got the mindset of a runner as well, we want it to go 500 pips. Okay, so like I said, we gonna try for 250 pips. With my strategy, we gonna try for 250 pips, but we are going to aim for the next zone. So we gonna get our guaranteed profits, and what's left on the table is just left on the table. If you are a runner, do not get upset when you get stopped out after the market goes in the expected direction in the expected direction initially. It is important to stay tuned to your trading beliefs. The best way to do this is to avoid retrading the last trade. In fact, retrading the last trade may send you in a cycle of doom. Never a fun place for traders. In the next chapter, we examine this cycle in detail. Part 3, Trading Psychology. Let me get some water. The Forex cycle. Insanity is doing the same thing over and over again, but expecting different results. Rita Mae Brown. It is true that the most traders do not consistently find profits. The vast majority of Forex traders lose money consistently. Because of this, many traders find it difficult to stick with a trading system. The vast majority of traders are always looking for a new and improved trading system. The trading system gets the blame for all the losses. It's so funny because the market is the only thing that should get the blame. Most traders are therefore constantly searching for a better trading system, looking for a solution to the consistent losing. See, like that was the thing. I just read the second line with the first word. Oh my gosh. Losing. The ironic thing is that the solution has nothing to do with the trading system. An explanation of the cycle of doom will help you see how you can break out of this cycle if you are currently finding it difficult to reach consistent profits. What is the cycle of doom? The cycle of doom consists of 3 phases. The first phase is the search. The second phase is the action. And the third and final phase is the blame. A close look at each of these phases reveals that the cycle of doom characterizes a logical approach to trading. To become a successful trader, however, you will have to break out of the cycle of doom. How do you break out of the cycle of doom? The first step is to understand the cycle. Once you understand the cycle of doom, you may break free from the cycle of doom. It is important for you to understand what is happening so you may identify it, and then move beyond the cycle of doom and into the world of consistent, profitable trading. Phase 1, the search. In this phase, you are searching for a trading system. You may look for trading systems in trading books, in online trading forums, trading education website, or you may find your trading system from speaking to another trader at a conference or meeting. In the end, this is not important where you find a trading system, only that you find a trading system that appears to be successful. If you are unable to find a trading system that you are comfortable with, then you're probably in phase 1. You will leave phase 1 only once you find a trading system that is truly exciting, a system that you look forward to trading. In fact, phase 1 of the cycle of doom is complete once you find a trading system that you simply cannot wait to trade. The defining feature of phase 1 is that the trading system is the solution. Once you have found a trading system that is exciting, you will move beyond phase 1. Phase 2, the action. Phase 2 is the action phase. This is the fun part. You begin to trade your trading system. If you are like most traders, you will leap into phase 2 with just about every trading system that looks decent. The excitement of using a new trading system is irreplaceable. The excitement comes from the unknown. More about this later. Will this new trading system work? Will you become a billionaire trading this system? Is it everything you hope to be? Amid this excitement, you begin to trade this system with high hopes. It is highly unlikely, given that you are extremely excited to start trading your new system, that you will have time to test your trading system. The proof for your new trading system is so overwhelming that there is no need to test the trading system. If you decide to test your trading system before jumping into the action phase, congratulations. You are a member of the cautious minority of traders. This is the exciting phase because you're able to put your trading system to the test. You may not have decided to test your trading system before moving into the action phase. In fact, only a small percentage of traders do test a trading system before moving into the action phase. I did that, and I'm still doing it every Saturday. This action phase is punctuated by excitement. It is excited to a new system, not knowing what may happen. You may find that the trading system does well for an extended period of time. Perhaps you find the optimism abounds. However, at some stage things look bleak. May profits pour in early, but eventually the losing trades pile up. A drawdown eventually appears. There are several losing in a row. These trades may have appeared just as you decided to increase the risk per trade. Obviously, this wall is ill-timed modification to your trading system. Just as you decide to increase the risk per trade, the system ran into a bumpy road. This drawdown is the beginning of the end of phase 2. Excuse me. This drawdown will mean that you lose faith in your trading system and begin to move into the next phase. Phase 3 is the blame. Like I said, the market is the only thing to get blamed. The blame is the phase in which the trading system is scrapped because the trading system has not found consistent profits. You decide to dump the trading system. The trading system is at fault. The trading system found the losing trade. The trading system must be responsible for the drawdown. Frustration sets in because the system that looked for so foolproof ended up being a loser. You decide it is time to move on to a new trading system. Return to phase 1. The cycle of doom is punctuated by a return to phase 1 after phase 3. Once you have completely given up on your system, you decide to find another system, a better system. The search is on again. The cycle repeats itself once again. Figure 12.1. Most traders find it difficult to break out of the cycle of doom. The search, the action, the blame. The search, the action, the blame. The cycle of doom makes sense to the trader who is convinced that profits come from trading systems. The problem is this: profits do not come from trading systems. Profits come from traders. Traders find profits in the market. Like I say all the time, it's the execution. The execution, not the trading system. The trading system helps you get come from the traders. Traders find profits in the markets. And the tool trading system, quote unquote, use the extract thing, that's not even a quote. use to extract these profits is not as essential as the trader's execution. The fatal mistake that most traders make is to assume that trading systems are responsible for profits. Living in the cycle. The cycle of doom may be familiar to you. It is certainly familiar to me. It was stuck in the cycle of doom for years. Losing consistently is no fun. I should know. I did it too often. I did it often. Yeah, I lost like what, 2,000 maybe. You know, just testing my waters, trying to hope that I get what I need to get. Okay. Wow. I shouldn't. It may be difficult to believe, after spending years trading and losing, that it is possible to reach the land of profits. If you are steady losing, you obviously believe. Because losers don't keep losing, they give up. Once you start believing and you know that it's possible, you'll never give up. Exactly why I started. I kept doing the YouTube. Like I'm not doing this because, hey, because I see other people doing it. I'm doing this because I know it works. That's why I'm doing it. However, it is possible to achieve consistent profits trading Forex. The first step towards profitability is identifying that you have been stuck in the cycle of doom. A close examination of how many traders approach trading reveals that the cycle of doom is due to how traders approach their trading, and not the viability of a trading system. Another way to look at this is considered that two traders may be trading using the same system. One trader is consistently finding successful, profitable trades, and the other trader is consistently losing money because the execution is not there. What is the difference between the two traders? They both trade using the same system. The difference is in the trader. The key to breaking the cycle is to recognize that the trading system is not responsible for trading profits or losses. You are responsible for trading profits and losses. Defeating the cycle. It is possible to defeat the cycle of doom. I have done it, and many other naked traders have also broken the cycle. You can certainly defeat the cycle of doom. Okay. you must want to become a professional trader. If you want to trade consistently and if you want to find profits, it may be best for you to stick to a trading system that you believe in. One way to gain confidence in your trading system is to backtest it. You already know this. Have you done it? Have you tested any of the trading systems in this book? If you have not, perhaps you are not ready to defeat the cycle. But do not lose hope, for there may be another opportunity for you to find confidence in your trading. There may be very good reason why you have not backtested any of these trading systems at this stage. It may be that you are waiting for a trading system that resonates with you. Perhaps once you find this trading system, you will be able to go and test it extensively and build your confidence in this trading system before using it in live market. If this sounds like you, then the next chapter is for you. You are the type of trader who must create your own trading system. You must trade a system that is completely yours. This is fine. You are in good company, and there are many traders who, like you, must trade only a homegrown system. Trading your own systems may be the best way to avoid the cycle of doom, and this is explored in detail in the next chapter. Chapter 13. Create your trading system. My parents taught me how to listen to everybody before I made up my own mind. When you listen, you learn. You absorb like a sponge, and your life becomes so much better than when you are trying to listen to all the time. To be listened to all the time. Okay, I missed the B word. So, everything you are taught, you gotta listen. I do struggle at listening, according to everybody around me. That is the only thing that I struggle in, is listening. Years ago, I met a trader named Miguel. He, like many others before him, was interested in becoming a full-time Forex trader. We spoke about trading psychology, trading systems, reason for becoming a professional trader, and we talked about how boring trading is. It is very boring now. It is very boring. But when you win that money, it be so exciting. I'm talking about you get up out your seat, you start dancing, doing the happy dance and everything. It be like that though. My friend was a professional in the finance world who worked at a bank in Switzerland. He really wanted to learn how to trade for consistent profits in Forex. I told him that once he learned to be an efficient trader, his trading will become very boring. He was shocked to hear this. It is true, successful trading is often boring. He did not believe me, but nevertheless, he thought it would be great if he became a more professional Forex trader. Many years later, my friend has left his job at the bank, moved from a chilly country to a nice, warm, tropical location, and he now trades a few times each month. He wrote me to say, "Now I know what you mean when you said that trading will become boring. I hope this happens for you. I hope that trading becomes boring. I hope that you do the same thing over and over and over again and find it very easy to pull profits out of the market. If you work hard, your trading may become boring. The key is to define who you are as a trader and as a person, not just a trader, as a person. Once you do that, you may put a plan to action that will allow your trading to become boring. So how will you define your system? The answer lies in who you are. Who you are will define how you trade. What makes sense to you as a trader may not make sense to me. This is fine. There are many ways to find profits in Forex. If a trader tells you there is only one way to make profits in Forex, he is wrong. Women trade as well, so she is wrong. There are many ways to pull consistent profits in Forex. You simply have to find your way. What do you believe? Your beliefs will drive your trading. If, for example, you believe it is impossible to make money scalping, then you will have a very difficult time making money scalping. If this is your belief, focus on longer term charts. Swing trading. The rules. The rules of your trading system will define how you interact with the market. It may seem like this is very small detail, but in fact, it is the definition of the game. Those traders who do not have rules, and many traders enter the market without rules, are simply gambling. Facts. It is important for you to define what your system rules are, if only for the fact that having them in front of you will help to remind you that you have a method for extracting profits. Beyond that, it is important for you to remember that your trading system rules also define what you should do in any situation. Your entries, your exits, your trade management, and your risk strategy should all be contained in your system rules. It may be tempting to create a system without precisely defining. It may be tempting to create a system without precisely defining rules, but know this: a well-defined trading system is more likely to withstand your personal psychological attacks against your trading system. Less interpretation often means better trading, and the best defined system are just like this: resistant. If you have experience trading, you know how tempting it is to modify your trading system just this time, or perhaps you have found yourself willing to override a trade signal your system offers just this time, or maybe just this time you have decided to move your stop loss to give a trade a little more breathing room. I regret that every time I do it, so I know for a fact that's not good. Just this trading leads to disasters. Exactly. And it is important for you to develop a trading system that is just this resistant. Are you a market specialist? The first decision to make when designing your trading system, is to decide which market you will be trading. All the systems contained in this book will work on many markets in most time frames. The question becomes this: which type of trader are you? You may decide between two basic trader profiles. The first is the market specialist. As a specialist, you will concentrate on one market. There are many successful traders who do this. Perhaps you only want to trade the EUR/USD. If you decide to be a EUR/USD specialist, you will learn the intricacies of the pair. Each market has a personality, and as a EUR/USD specialist, you will learn the personality of the euro. You might also learn the correlations associated with the pairs, when the pair is reacting in an unusual way, and so forth. At the time of writing this book, Ashkan Bowler, a professional Forex trader who is very similar with the EUR/USD market, had discovered a very particular correlation. Bowler had been exploiting this correlation with a scalping strategy for over 1 month. He had determined that the EUR/USD had been closely following the Dow Jones Industrial Average. By waiting for the Dow Jones established a direction for the trading day, he knew precisely which direction to scalp the EURUSD. He said, "I don't know how long the correlations will last, but for now it does make a consistent profit." Now it is important to note that as a market specialist, you will probably uncover similar relationships, such as this one, in your trading. Remember that these relationships will not always last. They are transient. Although it is great to exploit these relationships, you must always be on your guard when they start to fall apart. As a market specialist, you will discover relationships such as the one bowler used in this trading. You will become familiar with the market. You will know what it does around the non-farm payroll report. You will know when the interest rates announcements are for your market, and you will be aware of what the currency pair is likely to do. As a market specialist, you will discover relationships such as the one bowler used in his trading. You will become familiar with the market. You will know what it does around the non-farm payroll report. You will know when the interest rates announcements are for your market, and you will be aware of what the currency pair is likely to do. In general, you will have a feel for your chosen market. This is the great advantage. Some traders begin trading with the belief that they must trade every market available, and that simply is not the case. Market specialists are some of the most profitable traders on the planet, and many of them have an exceptionally high win rate. This comes with the understanding of the market and have an intimate relationship with the market, the factors that affect the market, and methods for determining the mood of the market. So you think that becoming a market specialist is for you, then make sure that you backtest your chosen trading system extensively on your market. You may be surprised at what you find. Market specialists will sometimes use several different trading systems on the same market. Perhaps you decide you want to become a market specialist and work only with the GU. This may mean that you are using several trading systems on the GU. For example, you may decide to trade the daily kangaroo trades on the GU. You may also decide that you are going to take the last kiss trade on the 4-hour charts. As a market specialist, you may even find that you are simultaneously long and short, buying and selling your currency pair, simply because you are trading multiple time frames and strategies. This may seem confusing or unlikely, but if you choose to follow the path of the specialist, you may find it make sense to follow the short-term and long-term impulses of your chosen market. Simultaneously, perhaps buying your market on the 1-hour chart and selling it on the weekly chart. These seemingly contradictory positions make sense only to the market specialist, the trader who has intimate knowledge of the market he trades. Are you a trade specialist? If the idea of trading one market does not appeal to you, then you may want to consider the alternative, becoming a trade specialist. As a trade specialist, you will focus on one trading setup. It may be all right. It may be the moolah trade or the big build. By the way, moolahs and whammies and them things don't work. They do sometimes though. Or perhaps trendy kangaroos. The setup you choose does not matter. You must simply be comfortable trading the system. You will gain comfort trading this setup across markets by backtesting. Obviously, this will involve backtesting. It is only through backtesting that you can accumulate experience and confidence in your trading setup to apply it across markets consistently and repeatedly for profits. Additionally, to become a trade specialist, you must get comfortable with all phases of the market. All trades are similar to a good store. They have a beginning, middle, and an end. In the beginning, the question is, do you want to take this trade? Is the risk for this trade worth it in your mind? Have you seen similar setups in the past that have worked out? If you feel as though you simply must take the trade because it is too good to be true, then you should take a trade. Okay. The beginning, in some ways, is the most difficult part to the trade. The beginning phase of your trade is when you act as a filter. You are filtering out those subpar trading setups. You, as a trade specialist, know precisely what those grade A setups look like. This will obviously come from your backtesting. You will have gained experience through your accumulation of knowledge. This only comes with exposure to charts, which only come from trading live accounts and demo accounts and backtesting. Based on your trading experience, you will know which trade to filter out. This is the most important and critical phase of the trade that as a trade specialist. The second part of the trade occurs when you are managing the trade. The market biofeedback comes in. Does the market provide any critical information about the trade? How do you feel about the trade given the price action that it has printed after entering the trade? When the market tells you what to do, make sure you are ready to act on this information. Disregard the market information is stubborn trading. If you join the group of stubborn traders who hold onto believing despite contradictory market information, you too may find them to be very expensive belief. See chapter 16 for more on expensive belief. The third and final part of the trade is the exit. Now, your style of exit strategy is obviously something that is unique and special to your personality. You simply must trade and exit in a way that makes sense to you and fits with your view of the market. The exit is where the money is made. Exits literally discriminate traders. Traders who constantly make money know how to apply exits. Those traders who constantly lose money usually have great difficulty with exit. If you doubt that exit control your trading destiny, then consider this. Have you taken the exit challenge? Learn how to test the power of exits using that link. If you have seen the power of exits. By applying an exit strategy, you are able to constantly pull profits, regardless of why you have entered. If you have done the exit strategy challenge, then you know how powerful a proper exit strategy. If applied consistently, you will bring home money consistently. It's not too late to do the exit strategy challenge, so if you have not tried it, please do it. It is a great way to put the exit in perspective. As a trade specialist, You will become familiar with each phase of the trade of your choosing strategy. You will learn how to discriminate good setups from poor setups. You will learn how to discern if a trade is going well or if it is not going well. And you will learn how to apply your chosen exit strategy constantly. Note that all trades may experience a drawdown, but the experienced traders, a trader who understands market biofeedback, will know when to pull the plug on a trade that is poorly performing. You will have to backtest your chosen specialty to build your confidence and become an expert with your trading system. Experience trading your system across a broad range of markets is important if you are to apply this system confidently and consistently. You may find, for example, that as a specialist trading the last kiss trade, it works extremely well on the 4-hour charts and the daily charts. But when you apply it to the 1-hour charts, the win rate plummets for you. This is valuable knowledge. And instead of trying to fight the system, knowing how you trade it and which time frames are effective are important pieces of information that you can use to improve your trading and your success. Choosing your time frame, choosing your market is important, just as important as choosing your time frame. There are 3 questions to answer when considering the time frame you are willing to trade. First, what type of person are you? Your trading personality will go a long way to determine the time frame that you will feel comfortable trading. Second, how much time do you have during your day? Traders who have considerable time to trade may be able to trade lower time frames, such as the 5-minute or 15-minute charts, but people with very busy days may not be able to trade anything other than higher time frames. Third, are you a patient trader? Patient traders will be able to endure the inevitable fluctuations in long-term trades. But impatient traders find it very difficult and end up trading shorter time frames. In fact, impatient traders make very good scalpers. Before you decide on your chosen time frame, remember these 2 principles. First, the shorter the time frame you decide to trade, the more intense concentration you will need to sustain to be consistently profitable. Second, as a rule, traders who start out trading longer time frames and trades those time frames successfully for months or years have a much higher success rate than those traders who jump straight into the 5-minute charts. So choose your time frame carefully. Risk rules. Trading is simply a game of managing risk. How many trades will you take at any one time? How large will your trade position be? When thinking about risk, there are 3 key aspects you should consider: your risk appetite, maximum drawdowns, and correlation trades. Risk appetite. The simplest rule to apply is to think about your sleep. Dang, that's crazy. That's deep right there. If you are able to put a trade on, place the orders in your platform, and then go to sleep, this is the trade size that fits your risk profile. If, however, when you place a trade, you find it difficult to sleep, you find that you are always thinking about the trade while away from your computer, then the trade is too big. You need to reduce your trading to a sleeping point, the point at which you can place a trade, accept the risk, and get a good night of sleep. Facts. Sleeping point. The point at which you can place a trade, accept the risk associated with the trade, and get a good night of sleep. If a trade is constantly on your mind, or if you find yourself checking a trade at odd hours in the night, there is too much risk associated with the trade, and it should be reduced to the sleeping point. Maximum drawdown. Your appetite for risk will help determine the size of your trade, but so will your maximum drawdown. The maximum drawdown is the amount you are willing to lose over a period of time. An easy way to track the maximum drawdown is to look at it from the point of view of one trading week. For example, you may risk 1% of your account on each trade. If you set your weekly maximum drawdown to 5% and can withstand 5 losing trades in a row, after 5 losing trades, you have hit your maximum drawdown for the week. You may decide to stop trading once your maximum drawdown is hit. How you decide to apply the maximum drawdown rule may depend on the time frame you decide to trade. You may decide to have a maximum drawdown per month if you trade a longer time frame. If you trade shorter time frames, you may decide to have a maximum drawdown amount for one day. It is up to you to decide. Note that your maximum drawdown will affect how many trades you are able to take at any given time. For example, you may decide to have a maximum drawdown of 5% for each trading week. If you have 6 daily trade signals on the first trading day of the week, and you risk 1% on each of these trades, you could have a drawdown of 6%. Should all those trades go bad at once, the implication, of course, is that you should reduce your risk so you are unable to reach your weekly drawdown on the first day of the week. If all of the trades end up losers, So if you have a 5% drawdown rule per trading week, you have 6 trading signals in one day. Perhaps instead of risking 1% per trade, you risk 0.65% per trade for an overall risk of 3.9%. This way, you have another 1.1% to risk the rest of the trading week, should all 6 trades become losers. Another critical question you must ask about your trading system is this: how will you deal with drawdowns? Will you use a stop trading rule? How will you recharge your batteries and jump back into the trading after a drawdown? Perhaps you believe that a drawdown retreat is a good idea. You may decide to get away from the charts and, if possible, get away from your trading solution and take a trip out of town after experiencing a drawdown. The theory behind this is if you get away from trading for a while, you will 1. Avoid revenge trading, good, a quick way to blow up your account, and 2. Come back to the charts with a fresh perspective. The best way to come back to the charts fresh is simply follow a planned sequence. Whenever you experience a maximum drawdown, for example, you may decide to follow this 5-step sequence. Go away. You will get away from your trading station and away from your home or trading office, even if only for the weekend or a couple of days. It is important to remove yourself from the place where you have experienced the drawdown. Backtest your system. This should be a predetermined number of trades, 200 trades for example, or a set time period, EURUSD daily chart from 2009 to 2011. Evaluate your trading statement. What has been working well? What has not been working well? Is the drawdown due to a bad luck, or is the drawdown due to a lack of discipline? Are you following your trading rules? Perhaps there are a few currencies that occur for 85% of your losses. Take a good look at your trading statement to see what seems to be working, what needs improvement. Make sure that you go back far enough with your statement to see what was working for you before the drawdown. Decide if your system still works. You have backtested and you have examined your trading statement. If your trading statement reveals nothing more bad luck and backtest suggests your trading system still works, it is time for another test. Test your trading system on recent market data. This way, you can be sure that your trading system no longer works. If your drawdown has occurred over the past 3 weeks, take a close look at recent market data from the past 3 months to see if the trading system is profitable. If you have found that the system is no longer profitable, it might be the best to stick on to a demo account when you begin trading again. Demo account. For a short demonstration account, many Forex brokers offer free practice accounts, also called demo accounts. These accounts allow Forex traders to become comfortable with the trading platform, and they also allow traders to test trading systems with real markets. These accounts will keep track of the winning and losing trades because they are funded with an amount of simulated money such as $50,000. Demo trading will ensure you that you do not lose money if the trading system no longer finds consistent profits. You must be careful of jumping back into the cycle of doom when doing this. If your trading system no longer turns a profit and you are applying the rules consistently, it is time to find another trading system. Work for you. 5. Work for you. You are the most critical aspect of your trading system. When your confidence is shaken after a serious drawdown, you should transition back into trading carefully. The goal should be to build up confidence. The two easiest ways to build confidence are to backtest your system, see it working over historical data, and to create a positive mindset. Specific tools for improving your trading psychology are covered in chapter 16. Decide and plan for your approach to a drawdown. Nearly every trader will have to sit through one of these difficult times. Professional Forex traders Ashkan Boger suggests that there is always time for making money in the markets. He says if something is not working, step away. Reanalyze your trades, and then come back to the markets. Stepping away from the markets will give your mind and your body time to rest, and you will be much better for it when you come back to the markets. Coming out of an extended drawdown, your goal should be to slowly build up your confidence. It is necessary to have a regimented routine for getting through these drawdowns. With a strong culture without rules designed to keep you from emotional revenge trading after a breakdown, you are almost certain to fall into undisciplined trading and to take on excessive risk. Design a plan today so that if a drawdown appears, you are ready for it, because you will not feel like designing a drawdown plan in the midst of a drawdown. Yeah. All right, I'll be right back. Correlation trades. Correlation trades are perhaps the most obvious threats to your trading account. For example, from time to time, the market may print daily kangaroo tails on many of the yen pairs. If I decide to take the daily kangaroo trade on the USD JPY, AUD JPY, NZD JPY, CAD JPY, EUR JPY, and GBP JPY, I must be careful. What will happen if each of these trades are available on the same day, and I have a maximum drawdown limit of 5% for the week? With a risk of 1% per trade, I quickly reach my weekly drawdown limit simply by taking these trades, should they all end up as losing trades. Yeah. One obvious solution is to reduce the per trade risk when several correlation currency pairs offer trading setups. If you have a background on statistics, you understand what a correlation is. But if you do not understand correlation very well, take a look at the correlation video at that website. You will learn how to measure the correlation between any two currency pairs. Once you have determined that two currency pairs are correlated, the next step is to reduce your overall risk for correlation trades. Here is an example of a plan for managing correlated simultaneous trades. Bullish kangaroo tails print on the daily charts for the following pairs: UJ, AJ, NJ, CJ, EJ, and GJ. The standard risk per trade is 1%. The maximum weekly drawdown is 5%. For simultaneous trades with a correlation of 0.65 and above, the risk is reduced to 0.5% per trade. The correlations are run on the 6 currency pairs, and all are correlated above the 6.5 level, so the overall risk per trade is set to 0.5% for an overall risk of 3% on the day. Even if all 6 trades end up as losers, the drawdown will be only 3%, so there will be 2% of additional risk available for the week. 2 standard trades at 1% risk each. Decide, how will you manage the risk on correlated pairs? As with every other aspect of your trading plan, you decide on a plan of action before you are in the midst of high pressure trading decision. So MIST is so funny because I just learned it not too long ago. In between, that's what in the midst is, in between of a high pressure trading decision. You and your trading account will be much better off. Managing your trades. The way you manage your trades is completely a personal decision. There are 2 parts to managing the trade. The first part is managing the entry price. The second part is managing the exit. Both decisions may be personalized depending on the way you decide to approach your trading. As for the entry price, there are several possible methods of entering a trade. You may take a market order, executing the trade at the current market price. You may take a limit order, executing the trade after the market retraced or moves in the wrong direction. Or you may decide to use a recommended buy stop or sell stop for sell trades. Executing the trade entry only once the market moves in the expected direction. Additionally, you may also decide to use an alternative entry strategy. You may wait for the market to offer a clue. In other words, you enter your trade once you receive market feedback, and once the market suggests, you will move in the expected direction. Managing the exit is also critical. There are many exit strategies available to you, many of them listed in Chapter 11. However, you also decide to manage your exit based on the market activity. Some traders believe that all trading decisions should be made before the trading is triggered. In other words, the entry price, the stop loss placement, and the profit targets are all determined in the beginning, before the trade is initiated. This way, there is no thinking after the trade is triggered. Traders who adhere to this philosophy attempt to get out of the way and allow the market to race the trade as a winner or loser. Some trades take this approach because they have jobs outside of trading. This restricts their availability for managing the trades. This limits exposure to charts can be a good thing. Sometimes traders get in the way. Traders may get in the way during the analysis of the market when decisions are made concerning which trade to take. Many traders have found that too much market analysis is counterproductive. It is often easier and more efficient to have a quick look at the markets, decide on the course of action, and then to simply set the trades and forget them. Abe Kaufness, a re-owned trader who deals in both spot Forex and Forex options, has this to say about the market analysts. It is so fascinating to see, but for me, I often find my best trading results occur when I do minimal analysis and let my visual sense of price action let me react to and not anticipate conditions. Confidence is certainly not alone. There are many traders who follow the same philosophy. Sometimes traders can simply outthink themselves, and it may also come during the exit phase of the trade. Colin Jessup, a naked Forex trader in Canada, has this to say about managing his trades. If price action retraces more than 61.8% towards my stop, I will close the trade to minimize the loss. Usually the 70% level is my line and the stand if I'm watching a trade live. That said, due to my schedule, my trades usually either hit my target or stop me out. Decide for yourself how much management you will do when trading. Stick to these rules. Try to duplicate your back testing in your live trading. This will ensure that your live trading result will resemble your back testing results. Managing stops and profits. How will you take losses? Will you wait for the market to hit your stop loss, or will you close out the trade manually before your stop is hit? Will your profit targets be achieved automatically, or will you wait to see if the market can push through the zone before exiting? Are you a runner or a gunner? If you are a runner, your stop loss and your profit target may be one and the same. For example, if you are using 3-bar exit, if you are a gunner, you will leave your profit targets in the trading platforms and walk away. Your disposition and your lifestyle will probably answer these questions for you. If you are at work during the day and are unable to manage your trades, you may need to let your trading platform do the managing for you. If, however, you are a full-time trader or have access to your charts nearly all day long, be careful. It may seem like a good idea to be able to watch the charts all the time. It may seem like a good idea to have your trades available on your phone all the time. Sometimes watching your trades unfold may mean you exit a trade prematurely. The rule of thumb here is to trade your system just as you backtested. You make sure that your backtesting duplicates how you will trade in your everyday life. If you get very nervous watching your trades, then it is probably best that you walk away. It may be best for you to let your trading platform manage your trade. If you find yourself making poor decisions when watching the live markets, the Forex trading platform today are brilliant and they offer many opportunities for trailing exit, the ability to move stop loss based on the market action, and so forth. Know who you are as a trader and what your weaknesses are. If you find yourself doing better, capture more profits when you step away to allow your trades to either hit the take profit or the stop loss. Without your intervention, perhaps you should stick to this hands-off approach to managing your trades. Perhaps you are able to manage your trades successfully and cut your losses before they hit the stop loss. The important thing to remember is that a few poor trades do not mean you should redesign your trading system. Beware of the cycle of doom. Using market information. The market is constantly sending information to market participants. What will you do with that information? Will you take market data and use it to adjust your entry strategy? Will market information help you to manage your exits? For example, if you're looking to take a bullish kangaroo tail, you may decide to place your buy stop above the high of the kangaroo tail. But what if the market trades down to the stop loss level before the buy stop entry is triggered? Does this mean that you will disregard this trade and remove your pending buy stop order? See figure 13.1 for example of this scenario on a 1 hour GU kangaroo tail setup. The GU prints a kangaroo tail on the 1 hour chart. However, instead of pushing through the buy stop order, the market falls lower than where the stop loss will be. Most naked traders will cancel the buy stop in this situation. If the market pushes through where the stop loss will be, it may make sense to cancel the trade. This is using market information to manage your trades even before they occur. You may also use the market information to manage your exits. If you are in a trade and the market prints a reversal signal, how will you react? If you are in a sell trade and the market prints a buy signal, will you exit a trade? Will it depend on where the reversal signal prints? Some naked traders will only close a trade if the market prints a reversal signal on a zone. Other naked traders will simply close a trade as soon as price action offers a counter signal, a signal in the opposite direction of the trade. Decide how you will manage a reversal signal. If you are in a buy trade and the market gives a sell signal, will you exit? Take a look at the daily NU chart on figure 13.2. This is a sell signal, a bearish kangaroo tail on the 0.7590 zone. The market triggers the trade and falls as expected. However, once the market reaches the zone at 0.7430, an interesting candlestick prints. This is not a bullish kangaroo tail because the open is not inside of the previous candlestick's range. Nevertheless, the candlestick does suggest that the market has found support here at the 0.7430, and thus the naked trader may decide to close the position. The daily NU chart prints a bearish kangaroo tail, suggests the market may fall. The market does fall, but once it reaches the next zone at 0.7430, a bullish almost kangaroo tail prints, suggests the market may move higher. Decide how you will use the market information. If you are me personally, I would just wait until it closes out of the zone. I'm not too particular in trading inside of here, inside of there. Decide how you will use market information. If you are very comfortable interpreting price action, perhaps you will use market information to adjust your trade as the candlestick prints on the chart. For many traders and those new to naked trading, it may be easier to simply stick with your trading plan and let your trade reach the profit target in the stop loss. Knowing your trading personality. The most important factor in determining how you will trade is your trading personality. What is your trading personality? How do you know what to do best? And how do you know what is uncomfortable for you? The basic distinction amongst traders is the one that distinguishes short-term scalpers from longer-term swing traders. You probably already know which camp you belong to. If you find it difficult to go to sleep or walk away from your charts knowing that you have money at risk, then you either 1, have too much at risk for your trade, or 2, you are not fit for trading longer term charts. Likewise, if you find it nearly impossible to sit through a trade on the 5-minute chart watching your equity seesaw back and forth, you are probably best suited for the longer term time frame charts. What makes sense to you? Do you like to trade? Do you like to take trades with the flow of the market, or do you like to find reversal points? Take the trading personality quiz to find out which trading system fits your view of the markets at that website. Typically, traders fall into one of the 2 categories: go with the flow, trend traders, and 2, reversal traders. The trend traders are drawn to the runners, exits in chapter 11, and the reversal traders often enjoy trading for profit targets. You may remember this group from chapter 11, the gunners. Remember that you may not have the patience to stick with the trade and ride out a long-lasting trend. If you are a reversal trader, quick profits targets may be more your style. If you are a trend trader, you will have to learn to deal with those trades that fall back and end up as break-even or losing trades, even after they start out in profit. Trades what makes sense for you. If you think it is easier to find turning points, trade reversals. If you think it is easier to ride the trend, make sure you get good at identifying and riding strong trends. Your life, your trading. How often you trade is absolutely critical decision. Trading can deplete your psychological and can deplete your psychological energy. I thought I was going to say psychological and psychological. I was like, okay, but I had to read the last word. Okay. If you don't believe this, then consider this. Next time you have an exceptional trade, a trade that backs several hundred pips, once you close the trade, try to immediately make another trade. Wait. Will you find it easy to make another trade? Of course not. The reason is that trading is draining and you must take care of yourself. As a trader, you must be physically fit. Yeah, you do. It's crazy. A healthy body equals a healthy mind. To stay healthy, you must get more than adequate sleep. You must take good care of your body. You must try to limit your time in front of a computer screen. If you fail to do these things, your trading will suffer. Okay. You can even make a game out of it. Perhaps you decide that you are only able to trade if you do some exercise that day. Okay. Or perhaps you decide that if you do not at least get 7 hours of sleep, you are not allowed to trade the following day. Okay. The idea here is to set goals to encourage good habits. One habit is to avoid as a trader is drinking and trading. It may seem like an obvious pitfall, but if you do drink, avoid trading under the influence. Oh, okay. I was so like, what, drinking? Well, like, you can't say I can't drink no water. Whoa, we can't drink no green tea or no coffee, man. What's going on? All right, just as you would not want to drink alcohol and go for a drive, you certainly do not want to drink a bottle of wine and then decide to scalp the GU for a few hours. As a Forex trader, you are well aware of the fact that the market is nearly always open. For many traders, it can be tempting to trade into the wee hours of the night. If you are under the influence, it is best to avoid making any trading decisions. Good habits should extend into the psychological realm. If you enjoy self-hypnosis or meditation, you may find your trading improves drastically when you consistently find time each day to practice self-hypnosis or meditation. There are more resources for you at fxjake.com/book if you would like to learn more about meditation or self-hypnosis. Perhaps you decide to take some time each day to mentally recharge before you make your trading decision. Before you sit down and analyze the charts, if you are thinking right now, I do not need to spend any time being quiet. I just do not have time for that. Please at least consider a new approach to your trading. For 1 month, try to using self-hypnosis, meditation, or just some simple quiet time alone before you jump into your trading routine. You may find your trading results improve. Something as simple as some quiet time alone can recharge your psychological batteries, and better batteries will mean better trading results. Trading will suck the psychological energy from you if you allow it to happen, so be careful. Trading 6+ hours per day is possible, but probably only for those people who are full-time traders. If you are trying to work a job and trade 6+ hours each day, you are probably going to be an inefficient trader. You may make mistakes, find it difficult to concentrate, and find it difficult to stay consistently profitable if you are working a full-time job and working as a trader full-time. It may seem as though trading is a wonderful, carefree life, but it is work. Yes, indeed it is. How subjective is your trading? The last important facet of your trading system, face it. How do you say this word? Search in Google for faucet. Facet. All right, so I think I was right the first time. The last important fate. Hold on. No. Control Z. Control W. Control T. Click 1, 2. Facet. Yeah, okay. All right, we got it. Facet. Where we at? The last important facet of your trade, like fastening a seatbelt. Facet of your trade. One side of something, many-sided, especially of a cut gem. A particular aspect or feature of something. Any of the individual units that make up the compound eye of insect or crustacean, something like that. All right. The last important facet of your trading system is how much room for interpretation you are allowing in your trading system. Do you decide to take only those trade setups that look right, or do you take only those trades that are strictly defined by your trading system? Each trader takes a different approach to the application of the trading system. For example, perhaps Trader Elliott decides to trade the big shadow setups on the daily charts. Elliott will only take those big shadow setups that look to be very high probability setups. The bearish big shadow setups must have a close down near the low, and the bullish big shadow setups must have a close near the high. The big shadow candlesticks must be very large, and Elliott decides to only take those big shadow setups that trigger the entry price on the next candlestick, and he takes profits at the nearest zone. Elliott may believe that he is using a very strict, well-defined trading system, but if you ask Molly, she might disagree. Trader Molly decides to also trade only daily big shadow trades. Trader Molly takes a different approach. Trader Molly will only take big shadows that are larger than the previous 5 candlesticks by at least 15%. Trader Molly also decides to only take those big... I tried to vivid that, by the way. Trader Molly also decides to only take those big shadows with the closing price within 15 pips of the low for bearish big shadows, or high for bullish big shadow. Molly constantly applies the 3-bar exit to her strategy, knowing that she may have some losing trades and small winners, but she will also have a few large winners. Some losing trades and small winners, but she will also have a few large winners. I just read that line. Where do you fall on the continuum? Are you more like Elliott? Do you prefer to trade with a little bit of subjective analysis, or are you like Molly? Perhaps you share her desire to have clear, concrete trading rules, so it is very clear what you would be doing when following your trading system. Field. In many ways, the time frame you choose to trade is determined by your lifestyle. If you don't have 4 or 5 hours a day to sit down and watch the charts, it will be difficult for you to have a 5-minute chart scalper. Unless you have an automated exit for your shorter time frame trades, it is unlikely that you will be able to trade the shorter time frame charts without several hours of screen time. Even if you do have an extra 4 or 5 hours each day, you may be better off avoiding trading the shorter time frame charts. Many traders have found it is much easier to simply take a look at the chart once a day, put in your trading orders, and then walk away. Sometimes after a few years of this sort of trading, successful traders will move down to shorter time frames.
A general rule of thumb is this: trading shorter time frames mean a smaller margin for error. Trading the shorter time frames means that you must be precise and decisive when executing your trades. An example will best illustrate why this is the case. If you decide to trade the 5-minute EUR/USD chart in the hopes of pulling 10 pips of profit from the market, then you are playing a high price to trade. The spread, the difference between the price for buying the EUR/USD and the price for selling the EUR/USD on the EUR/USD, is likely to be quite tight, perhaps 2 pips, so you must take 12 pips to bag 10 pips in profit. This is a commission of 16%. 2 pips divided by 12 equals 16%. This is a hefty commission. If instead you are trading the daily EUR/USD chart, you may be looking to gain 100 pips and will need to capture 102 pips to cover the spread. So this is the overall commission of the 1.99%, a significant reduction in the commission's costs. Longer term trading is not only cheaper, but it is easier to execute successfully. If you initiate a daily chart trade and enter your trade at a poor price, perhaps you miss your trade entry by 3 pips. You may instead make 97 pips rather than the full 100 pips. This is a reduction of profit by 3%. Not great, but certainly something your trading account can probably withstand. If this same type of poor execution is associated with a short-term trade, a 3-pip slip up becomes a reduction in profit by 30%. Sheesh, that's crazy. That's wild right there. 3 pips out of 10 is 30%. A consistent reduction in profits by 30% may tip the trading system over into the abyss of unprofitable system. This is your choice. You must decide if you have the trading experience, the time, and the mental toughness to constantly execute short time frame trades. If you do not have all three, it may be best to stick to the long-term time frame charts. All right then. Go and take a moment to shake my dreads. Ooh. Your trading lifestyle. As you can see, there is much more to your trading system than simply deciding on whether you prefer to trade the last kiss or trending kangaroos. Whether you like to trade the 1-hour chart or the weekly chart, it is important for you to decide not only what you will trade, but also how you will trade it, and to define the precise rules you will use to trade your system. Defining all these variables for your trading system up front will help you down the track when you have to endure difficult times. Drawdowns, losing streaks, and bad luck are all more manageable when you have a well-defined trading system in front of you. One last note should be made about your successes. When thinking about your trading system, much of your planning may involve reducing exposure to risk. However, you should also think about your success. What will you do when you have an exceptional run? Will you take the time off to celebrate? Will you pull some of your profits out to buy something nice for yourself? Remember to celebrate your wins. Yeah, I'm paying my bills. Define your trading system. In summary, creating your trading system involves several aspects. The following list will help you redefine your trading system and identify the rules so that you are ready for any situation before it arises. If your trading system answers all these questions, you have done it well, and you have a true trading system. Ooh. Oh my God, a true trading system. Are you a market specialist or trade specialist? How many hours of the daily screen time do you allow yourself? I'm pretty sure that they said what market specialist and trade specialist is, but honestly, I forgot. I just know I analyze the market right before the trade, and I wait for it to happen. How many hours of the daily screen time do you allow yourself? Between 1 to 3 hours per session. And I only trade New York and Asian for the moment. I haven't moved to anything else because of my time frames. Say I move to London, I'm gonna wake up and trade London, and I'm gonna trade New York. What is the Asian? Because Asian gonna be at nighttime. All right. Which trading session, European, Asian, or North America, do you trade? I just said what did I trade. Which time frames will you trade? 15-minute mostly, casually looking at the 30-minute, casually looking at the hour, casually looking at the 4-hour. But the 15-minute is more defined in my location. Which trading setups do you trade? I like to trade breakouts. Which exit strategy do you use? I use a ladder. So I go zone from zone, leaving my stop loss at break even, because, you know, better to get those profits and hope for more profits along the way by setting my take profit zone to zone. If it goes down to my initial take profit, my initial entry, that just means it was a dud. You know, you can't get all the money. You just gotta get money along the way. Get money. How much interpretation do you have when placing trades? Well, I usually do the top-down analyst, so I have a lot of interpretation when I'm thinking about a trade. I talk to myself. I say, hey, this is when I'm gonna enter the trade if this happens. How much interpretation do you have when exiting the trade? See, I honestly very low quality at that right there, because I would say I'm transitioning, but I was the type of trader that would let the losing trades go ahead and lose without taking partials of a losing trade, or lowering my risk, saying, hey, I know it's gonna hit my stop loss, let me go ahead and exit this trade. Instead of doing that, I would just let it run and let my profit, I will close my profit, like, and then as soon as I close my profit, it go to my initial take profit, like what I wanted it to go to. If I would have just waited, I'd have been straight. That's one thing I don't understand, man. They'll go to your stop loss so quick, but then it'll take them about 2 days to get to your take profit. It's crazy though. I ain't tripping. You know what I'm saying? What is your maximum risk per trade? Like I said, I risk 1 to 2%. So my maximum per trade is 2%, leaving everything. And sometimes I don't even do a whole 2%. If I notice, I also do like pips too. So I'm doing no more than 30 pips per trade. What is your maximum weekly drawdown? My maximum weekly drawdown is, I believe 5%. That's what I have in my notes. 3% for a day. I low-key don't really care too much about the weekly drawdown. I'm more on the daily drawdown. Just like I don't have the next question, a monthly drawdown, because you get what you get. I'm just happy that I'm getting to the point that I'm consistent and I'm not over risking anymore, losing 100% of my account in 2 trades, because like I've been there and definitely don't want to go back. How do you deal with drawdowns? The best way to deal with a drawdown is to just honestly not care. Hey, it's only 1%. It's only 1 or 2%. You know, That's not a lot at all. Even if you were, you know what I'm saying, a billionaire still doing 1 or 2%, it's not a lot at all. Okay? How will you regain confidence after maximum drawdown? Leave. What am I sitting here for being mad? I got a whole family. I'm finna go enjoy their company. I'm finna go play tea with my daughter. Something, you know? Play with the little tea stuff. Yeah. What will you do to ensure you are physically fit to trade? Well, I get up 4:30 in the morning and I exercise. Then I take me a shower. Then I come trade. And by 8 o'clock, I'm already tired again. But I go to work after that, you know, and I go make the money for what's needed for the moment until my social medias get to pop and I can start making them passive incomes where I don't have to go into a job and I can go actually enjoy my life, making more content, stuff that I actually want to do. What will you do to ensure you are psychologically fit to trade? That is one thing that I definitely need to start doing. Meditating. I definitely need to start meditating, because meditation gives you another level of you are built to do this. And that's honestly what I need. I need to start meditating. I exercise, I stretch, and I need to start meditating. So what I think I'm going to do is I think I'm going to exercise at night, like how I was doing at first. When I get up in the morning at 4:30, from 4:30, matter of fact, I might just go ahead and switch my time back to 5 a.m. And when I wake up at 5, I'm going to sit in the middle of the floor and listen to meditation music until 5:30. No, I'm going to continue waking up at 4:30. I actually like waking up at 4:30. And from 4:30 to 4:45, I'm going to sit and wake up. Then from 4:45 to about 5:15, I'm going to meditate, taking control of myself, my inner being, my inner life, my breathing, my mind, and my soul. And I am going to meditate, listening to peaceful music that makes sense, that moves the mind, body, and soul for 30 minutes every day to get me in that mode of hunger, desire, refreshness. All right, we have made it to chapter 14, everybody. Still a long way from the end, but we have came a long way from the beginning. Becoming an expert. Far too many people, especially people with great expertise in one area, are contemptuous of knowledge in other areas, or believe that being bright is a substitute for knowledge. Forex traders around the world are making money every day. All day, every day. These traders have one thing in common: a secret. And it's no secret, because he's about to tell us what the secret is. The secret may surprise you. If you are like me, when you first started learning about trading, you thought all traders who were making money were computer science, mathematics, or physics wizards with lightning fast computer deploying secret algorithms. I never thought this. I ain't even gonna cap to you. I not even for one moment in my life thought this. Trading was the domain of the well-educated that had the computer power to crack the market code. There's no code in the market. I was convinced that only by duplicating these efforts would I be able to consistently rack up profits. I knew that trading had to be complex, and perhaps you think same way. This is not true. Some of the very best traders in the world share a simple secret. They use extremely simple yet powerful trading systems. The best trader in the world, hedge fund traders, bank traders, private millionaire traders, you will never hear from them. All have one thing in common. These people are experts. They do one thing. Why do you want to trade? This may seem like a funny question. Give me a second. All right. So about 3:30, I'm gonna get off of this and I'm gonna finish it at a different time. Why do you want to trade? This may seem like a funny question, but why do you want to trade? If you want to trade because you want to make money, perhaps trading is for you. If, however, you want to trade because you want excitement, or you want to be able to tell people that you are a trader, or because you love the excitement of having money at risk, then perhaps trading is not for you. If you want excitement to skydive or hunting wild boars, I actually want to go skydiving. Not too much on hunting wild boars, because the only way I'm going to hunt a wild boar is if I have a machine gun. If you want to tell people that you are a trader, you can do that. But if you are not quite consistent with your trading, you just trade a very small account. That way you can get the recognition of being a trader for a small fee. If you love the excitement of having money at risk, you should try gambling. Gamblers are honest. I don't gamble. I hate gambling. They risk their money. They recognize the inherent risk to their occupation. They are upfront about it. My cousin, you're talking about my cousin right now. I don't appreciate you talking about my cousin right now. This is an honorable approach to gambling, because gamblers admit that their money is at risk and admit that luck will guide their winnings. Traders can be gamblers in disguise if they are trading for the wrong reasons. You probably know a gambler or two disguised as a trader. This is the difference between a trader and a gambler. I actually know a gambler that's disguised as a trader, and he is one of my good friends. But we are trying to change his mindset from trading as a gambler into trading real, only calculated risk trading. He actually got up to about 15K and then lost it, and then got up to about 8K and then lost that too. And now he's working and he's working and he's working, and he's going to continue working until we're dead. He's going to continue.
to work until we're dead, because now he is at that stage where he is becoming profitable. A gambler has no risk management, and a gambler is willing to lose large amounts of money quickly. A trader treats each trade as a calculated risk and manages each trade according to his system's rules. Gamblers can lose all the money at once, and traders lose only as much money as their system will allow. The distinguishing factor is that a gambler does not follow risk management rules, whereas a trader follows strict management control. Expert traders do more than simply follow strict management controls. They also concentrate on one trading technique. This is the real secret of expert traders. They focus on one market, one trading system, one ledge, and they use this edge in their trading repeatedly. Profitable trading is boring. Profitable traders are experts, and these expert traders do one thing over and over again. The secret of the experts. Why do profitable traders limit themselves? The answer is simple. Profitable traders know what makes money. Profitable traders trade to make money. If you would like to make money as a trader, do what the experts do. Become good at your one system. You know how to do this now. All you need in this book, you simply need to put the work in, practice, and become an expert with a trading system that makes sense to you, and then trade the trading system. Trade your system over and over again until trading becomes boring and very profitable. All the very successful traders are doing one thing. This may seem unbelievable, but entire hedge funds are built in one idea. Hedge fund traders often have one edge, and they use this edge on their trading. Now, some hedge funds may have several traders, each with his own hedge. But to be a successful trader, you simply have to have one thing that you are very good at, and then do this one thing over and over and over again. The most successful traders I know this rule. The traders that struggled, the traders who have difficulty finding consistent profits, are the ones who repeatedly change their system, reanalyzing and reorganizing their trading rules. In other words, they are still stuck in the cycle of doom. The key to breaking the cycle of doom is to decide what makes sense to you. Which of these trading systems in this book resonate with you? Once you have chosen one, you simply need to test it all over and over again. Then apply this system. Concentrate on the following your system rules, and watch your confidence grow. You can do the same thing hedge fund traders do. You can be just like the bank traders. You can be a professional trader, but before you go pro, you must decide how you will make your money in the market. What is your expertise? Which trading system fits your beliefs? Once you align your beliefs with a trading system, you simply need to gain experience and confidence in the trading system, and you will never look back. Your exciting journey is ahead of you. Soon you will become an expert trader. 6 steps to becoming an expert. Although it may seem that becoming an expert is very difficult thing to do, it is really rather simple. As with many things in life, you put the work into it, you will be able to reap the rewards. Here are 6 steps to becoming an expert. Step 1. Get in the comfort zone. The first step is to become comfortable drawing zones on your chart. Zones are the basis for your trading decision. As a naked trader, all your trading decisions will be based on zones. So it is very important that you have these zones drawn correctly on the chart. It is much easier to draw fewer zones provided those zones are very strong and well defined than it is to draw too many zones in your chart. If in doubt, that's like really a word. Excuse me. Be mistaken or incorrect. Make a mistake. That's crazy.
Everybody ain't your friend. Err on the side of using fewer zones on your chart. As a naked trader, you will spend a lot of time waiting for the market to hit your zones. This is fine. This is a part of what it means to be a naked trader. If you find yourself feeling as though you need to take action, perhaps you should backtest your trading. Test 1 year's worth of data on a shorter time frame and then test a lower frequency trading system on a longer time frame charts. Compare the profitability of each backtest. Are you surprised at what you find? Sometimes making money is easier when you do not trade. Sometimes avoiding trades is just as important as taking trade opportunities when they arise. Goal: learn to quickly identify zones on any chart. Step 2: decide on a catalyst. The second step towards expertise is for you to decide on which catalyst you will use in your trading. You have learned about several catalysts and there are more at that website, and hopefully by now you have backtested some of them. So which one resonates with you? Do you prefer the simplicity of the kangaroo tail, or do you like the added confirmation of the last kiss? Perhaps you find the trending kangaroo to be an excellent method for capturing trending markets. It does not matter which catalyst you have chosen. What does matter is that you trade a catalyst that fits with your view of the market. You must trade a catalyst that fits with your beliefs. Choose a catalyst that fits with your belief will help you ride out any bumps in your equity curve and avoid the cycle of doom. Go. Choose the one trading catalyst that you want to build your expertise on. Step 3. Backtest. By now, you probably have a good understanding of all the benefits associated with backtesting your trading system. Backtesting will verify that your trading system works. It will help to build your confidence in your trading system. It will help you when you are experiencing drawdowns. It will help save you from falling back into the cycle of doom. In short, backtesting is where separates those consistently profitable traders from those traders who are forever stuck in the cycle of doom. If there is one idea that you take from this book, let it be this: backtesting your trading system is the one thing that you can do to accelerate your trading. This one thing is the most important habit that you can develop in an effort to become a professional trader. Backtesting is that important. You should have a clear goal in mind when you backtest your trading systems. Try to triple your account with a small percentage at risk for each trade. For example, 1% or 2% at risk. Tripling your trading account will help you to believe in your trading skills. Risking 2% or less, tripling your backtesting account. Triple your backtesting account. If you step 4, forward test. If you have backtested your trading system, you are happy with the results, you're ready for the next step. The next step is to employ your trading system in real time. Unfortunately, this is a very slow stage. You'll be unable to speed up time as you can when you are backtesting, but you will closely mirror the live market trading experience. See, I actually started trading live and then I went to go backtest. So after I lost all my money and then I discovered a trading system that worked, and now that I've discovered the trading system that works, I am so confident in backtesting. At first, I was just looking at the chart like, well, they say go back. Okay, go back. Ooh, what am I looking for? Okay, the SMA is right there. The my zone's right here, and I was putting my zones in the wrong spot too. But now I feel so confident. Create a goal for your forward testing. Try to triple your demo account. Because you will be trading in real time, it will probably take longer to triple your account than it did when you tripled your backtesting account. However, in some ways, demo trading much more closely resembles real trading because you cannot quickly advance the charts to see if you have made the correct trading decision. So when trading, you should also remember that you should kind of feel it in your heart that just fake like you waiting 15 minutes for the candle, like wait like 5 minutes, 6 minutes for a 15-minute candle, and then go, and then wait another 15 minutes for the candle, or 7 minutes for a candle, and then go. It's gonna change it right there. Create a goal for your forward testing. Try to triple your demo account because you will be trading it in real time. It will probably take longer to triple your account than it did when you tripled your backtesting account. However, in some ways, demo trading much more closely resembles real trading because you cannot quickly advance the charts to see if you have made the correct trading decisions. Embrace the time it says to accumulate expertise with your forward testing. To forward test, you simply need to open up a demo account. These accounts are offered by any Forex broker. Risking 2% or less on each trade. Triple your demo account. Step 5. Trade a small account. After you have found success backtesting and found success forward testing, it is time to start trading a live account. Live trading can never really be duplicated. Backtesting is wonderful and adds to your confidence. Forward testing is also great because it closely resembles live trading. However, the only thing that matters is live trading profits. Begin with a very small trading account. What is small to you may not be small for someone else. The size of your account should be made up of 100% risk money. This is money that you are willing to risk for this exercise. Never risk more than you can afford to lose. Once you triple this small account, you are ready. You have built your confidence by trading, backtesting with historical data, live data with your demo account, and finally you have tripled your small live account. At this stage, you probably cannot wait to begin trading your standard live account. Risking 2% or less on each trade, triple your small account. Step 6. Trade a live account. Most traders do not do what you just have done. You have built your confidence over the previous 5 steps. Now you are ready. This is the time to put into practice what you know, and by this stage you will be excited. Make sure that you maintain your discipline and continue to do the same thing that you have been doing. The important thing here is to follow your system without regard to whether you are in the midst of a lucky streak I'm so hungry, ain't I? Or a unlucky streak. Remember, you have the power of your trading, and you understand that you will successfully pull profits from the market. The most important thing at this stage is to duplicate what you have been doing. Just because you are trading a standard account does not mean anything changes. Concentrating on your trading system will yield positive results. Thinking about the money involved in each trade will probably be distracting and will likely throw you off track. Keep doing what you do well, and you will become an expert. Goal: risking 2% or less on each trade. Stick to your trading rules. Focus solely following your trading system rules. Do it again. It is possible to duplicate these steps with another trading system. If you have decided to follow the path of the market experts, you probably will add more systems to your repertoire. It is not necessary that you will do so. It may be easier for you to trade one system comfortably for at least 8 months before attempting to become an expert with another system. Eventually, you may decide to do what many profitable traders decide to do. You may want to gain expertise with an additional trading system. It is not necessary to do so. It may be tempting to jump headfirst into another system, but you should first give yourself time to get bored with your first system. There are at least 2 reasons for becoming an expert with a new trading system. The first is that trading the profitable system is boring. Perhaps it seems crazy to you that you may one day become bored with consistent trading profits, but it may happen. You may want to expand your horizons and add another tool to your trading system. Trading tool test. The second reason for becoming an expert with a new trading system is based on risk management. By diversifying your trading strategy, you may reduce the likelihood of an extended drawdown. All trading systems have drawdowns, but if you have a complementary trading system, one that is likely to make profits while the other is struggling, then you have the making of a solid trading strategy. Many professional traders eventually get to the stage where trading diversified trading strategies make sense. This is not necessary, of course, but it is possible for you to become the expert all over again with a new trading strategy. This is a great way to reduce your risk. Alright, I'm going to be stopping. And I do definitely appreciate you guys for sticking around. Whoever came and watched my videos and left a like. Until next time, probably gonna be trading later. Probably not gonna be trading later. There's no guarantee on that, but learned a lot of things, and going to keep learning a lot of things.